Hey guys, this podcast is this one is a bit visual, so I recommend you to check the written version at stockpickinginsights.com. Um, but today we'll talk about S&P 500 rolling returns, and we will look at 10, 20, and 40 years. This will be without dividends, by the way. So let's go. First of all, why do this? If we are stock pickers, why even bother with the S&P 500? I like to do it because it gives me context on the market as an investor. In Also because I index part of my portfolio, so it directly affects my portfolio. We know that the past doesn't predict the future by itself, but it sure helps, and that's why we look at annual reports and financial statements. By looking at the past, we can see the best and worst of this crazy stock market, and that's why we should look at it. Um, Again, all the charts you are going to hear about below are without dividends. Next week, we'll go into those charts with dividends. And what does this mean? It means that we are just looking at capital gains, so we won't be able to withdraw conclusions for dividend reinvesting strategies. So if you are, for example, using accumulating ETFs, this article is not the best one for you. The best one is the one that comes out next week. But let's dive into it. Okay, starting with a 10-year time frame, you can see all the ups and downs of the rolling 10-year CAGRs, compound annual growth rate of the market. And you can see both real and nominal returns. So one is adjusted for inflation and the other one is not. In reality, what matters to us is the one that is adjusted for inflation, unless you have a pretty different CPI, a different basket from what the CPI is measuring. But that's for another article that it was already discussed in the past. You can check that one out too. And you have a chart that shows you the 10-year rolling returns for the S&P 500. And here we can see the difference between real returns and nominal returns. It is clear by looking at the chart. For example, during the World War One, we had 12 to 20% annual inflation, and that clearly shows in the chart because nominal returns were negative during those 4 years, but real returns were way worse, the worst in the S&P 500 history. We are talking about almost minus 10% CAGR over 10 years. So had you invested in, for example, 1906 and got out of the market by 1916, you would have lost 10% in real terms each year. The 1970s were another very dark period because we had several years of minus 6% 10-year CAGRs. So again, had you invested 10 years early, like the 60s, for example, you would ended up with minus 6% CAGRs had you got out in the 70s. So not all the years, but the first ones. This serves to say that bad times happened in the past and can surely again happen in the future. But a 10-year time frame is still not long enough to take some of the conclusions we would like to take, because 10-year is considered long term for me, but because I am relatively young, I will be here for more than that. So let's now take a look at 20-year returns. The chart is completely different from the 10-year one. It has some swings, but it is more on the positive side than on the negative side now. Our stock market looks a bit overpriced right now due to interest rates, but not so much if you look at the 20-year chart. Um, Here again, the 20s and the 70s look salient due to high inflation and low real returns. And by low, we mean negative. This chart shows that there were several periods in the S&P 500 history where 20-year real returns were negative. So, had you not reinvested your dividends and invested for 20 years, some of the periods you would be getting a negative real return and sometimes a nominal negative return too. Regarding inflation, the amount of printing, in quotes, says that we may be heading up from for some very high CPI inflation periods. The gap between the red and the black line, and if you are listening to the podcast, it means the gap between the nominal and the real returns is expected to widen again. So, because of inflation, nominal returns seem high. It seems that you are getting richer, but in real terms, the prices of the things you want to buy are also getting more expensive. Um, that gap is expected to widen, and the past has shown us that it is possible to have positive nominal returns with negative real returns. It has happened twice in the history of 20-year rolling CAGRs for the S&P 500. Okay, so finally, if you are in it for the real long term, you can take a look at 40-year S&P CAGRs. And again, this one looks very different from the 20-year and from the 10-year rolling return charts. It is interesting to see that some people were simply born at suboptimal times, and that's judging by the chart, the 40-year one. For example, a person that bought the S&P 500 and held for 40 years until the 1940s, and that's World War II, would incur 40-year real losses. So, um, had you stayed in the market for 40 years, if you are not reinvesting the dividends, it is still not historically guaranteed to give you a real profit. In the future, of course, nothing is guaranteed, but it has already happened in past history. So, two conclusions. The first one is that the S&P 500 is surely not guaranteed to make you richer in real terms over a 40-year period, because the opposite has already happened in the past, as we were just talking about. Secondly, and to end on a positive note, this article is a bull case for a dollar cost averaging strategy when indexing your portfolio, because it softens those 40-year-old variations and puts you in a better position to have positive real returns over time. Of course, nothing is guaranteed, but this goes to show that bad times happen in past history. And that's it for today, guys. We'll see you next week with a similar post, but this one will have dividends included. So this is for people that have invested in S&P 500 ETFs that are accumulating. So the dividends will be reinvested instead of distributed.